Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her website, JugglingDynamite.com. Welcome back to the show, Danielle.
Thank you, Jim.
The major markets seeing big dump today. Is this just a minor blip, or is this the storm that so many people have warned us of?
Well, it's very hard to say. We can't tell how crazy we'll get, but we know it's been about as crazy as it's ever been. So record crazy usually follows at some point with record correction, and certainly the phase we're in now with this whole rebound from the March low in the economy is starting to lose steam. And the revelation is hitting that a lot of the damage that's been done is not going to bounce back quickly, that jobs are not coming back fast, that a lot of the damage has been permanent. A lot of small businesses will not reopen, will not make it through the end of the year. As I like to say, the 2019 spending levels are not going to be coming back anytime soon. And unfortunately, a lot of business models are needing that if they're going to survive. And that's, a lot of surveys have sort of seen that stress in the business sector. The lending in banks has become much tighter for small businesses, although, the Fed's actions in stepping in and pumping the system with credit have certainly liquefied and allowed certain publicly traded companies to tap investors who are buying junk debt with next to no return. So it's helped some people reliquefy. But as far as the other businesses which are not, don't have access to public markets, can't sell bonds on the public market, they're stuck with conventional lending. And the loan officers' surveys have repeatedly shown that has been tightening significantly in the last couple of months. So that just means that, lines of credit are curtailed or canceled in some cases. Interest rates have gone up on, credit cards and other facilities that households and businesses have been using. Sometimes they've been frozen so that they can't actually take on more debt. And that's all because the picture of financial stability has been deteriorating under the guise of these emergency payments, right? So it looks like people are making ends meet, but that's only because they've been getting free money from the government. And in fact, the trustees in bankruptcies, the latest report that came out today from Hoyes Nicholas says that their insolvency filings have fallen to the lowest level in a long time in Canada, and that they see this as very much a calm before the storm, because the only reason that that's happened is that the courts have been closed, that people have been getting emergency money, and they've really deferred the revelation or the reality that they can't make their payments. So, all of that's been going on under the surface while we've had this extraordinarily euphoric jump in asset prices in publicly traded markets. But again, when you look under the hood, it turns out that it's really just a handful of the largest tech names. The Teslas that have, the Shopifys of the world that are up 300%. That's Canada's largest weight in our TSX, 7% weight is Shopify. It's up threefold since the March lows. You've seen things like Apple up 100%. The NASDAQ index, jumped 80% from the March low. So this is this basket of names, and it's really something, because I was alive in 2000, as I think you were too, Jim, and remember the tech wreck so well. It was my first bubble, coming into the financial analyst business in the mid-90s. I really hadn't seen anything like that. I'd read some stuff in textbooks, but boy, we've got another one for the history books here now. So to see a pullback today, is not surprising. You know, everyone was asking about margin debt and the leverage and the option trading that's been going on in the retail sector through places like Robinhood, which has really just added leverage on leverage on leverage, but in the weak hands, in the people that really don't have a clue what they're doing. They've only been making money so long as confidence has been rising and prices have been going up, and they're not at all prepared for a dramatic reversal, because, as I like to say, leverage magnifies the up but also the down. So we have record leverage throughout the financial system today. We've got record debt at every level, and we've got all this retail sector gambling, essentially, in the hopes that they'll win their way out of bankruptcy. So that combination is really quite toxic, where everyone is price indiscriminate. And I think what's probably more dangerous now than potentially even than March 2000 is that back in March 2000, you had a lot of overvaluation, and yes, the tech sector was leading it then, but there was also a broader complement of companies. Now we've had a lot of consolidation, a lot more monopolies in the system. These heavyweights that have really become enormous in the benchmarks. So just as an example, the top 5 tech companies in the U.S., you know, the Apple, Microsoft, Amazon, Facebook, Google, that group accounted for 23% of the entire price of the S&P 500 index before this recent sell-off. And that's the highest concentration of those top 5 ever in history, even in 2000. Apple alone made up 8% of the S&P before this sell-off today, and 14% of the NASDAQ. So when you look across the board today, what's down? Well, Tesla's down 7%, Apple 6%, you know, Amazon 5%, Microsoft 5%. So you knew that there had to be a blink, that someone was going to blink and either be forced to sell because of needing cash, or decide that they wanted to try and take profits. Or, you know, and once that happens, the cascade effect, you know, and the splitting of the shares for Apple and Tesla, this is all top tick stuff, right? Where the retail crowd doesn't understand that that's a way for them to be suckered in even more, and that corporations have really been making hay and taking advantage of their naivete and reckless behaviors. So it looks like everyone's, you know, making money until sort of the leverage plug gets pulled, and then everyone goes down the drain super fast. So these kind of moves, whether this is the final next leg down, which is overdue in the bear market that began in February, this is what I call phase 3, and whether it continues from today or whether it bounces a bit more, you know, whether we go from 50 times earnings to 55 times earnings on some of these big names and indices, who knows? But we certainly know that it doesn't go, trees don't go to the sky. It can't go on like this indefinitely. And I think the risk here is that a lot of people are holding baskets like indexes and ETFs and funds that track these benchmarks, really oblivious to the reality that they are so overexposed in these top 5 names, or in Canada, you know, the banks and Shopify, for example, make up a huge weight of the index. And when you have negative stories developing, price action, mean reversion in those names, you really get a tank in across the board of all these funds that are passively allocated. So it really has broad implications, I think this time even potentially more than it did in 2000.
Danielle, the U.S. dollar, what's it doing and what's it telling us?
Well, so we've been watching very carefully because the U.S. dollar peaked in March when the equity markets and commodities and everything sold off so significantly. The U.S. dollar was getting a huge amount of international inflows. So we covered our long exposure to the U.S. dollar then, and we've been patiently waiting for a reentry position into it. And we've been watching closely because it was bouncing around the 92 level in the past couple of weeks. And we were saying that's sort of a significant level in terms of the short-term strength. My partner Corey's done a lot of work on this. Anyway, the point is that it's now at 92.76, the DXY, which is a basket of global currencies. And if it indeed can hold in this level, that may be more indication that we've seen the top in the risk rally that began in March. And that once you get inflows coming back into the U.S. dollar again, you're likely to see a sell-off in everything else. So keeping in mind that teeter-totter is, I think, a very big picture important tool for people to keep in mind, that, a rally is always a rally of a finite duration. It's not going to be indefinite. So pick your points in terms of where you want exposure, but also where you want to take protection.
We'll have more with Danielle Park right after this.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Danielle Park. Danielle, will next year be an upturn in the economy again?
Well, we've been through an upturn in the economy since March, of course, the rebound from the shutdown. But I think the more relevant point here is that it's fine to have a rebound and some reopening. But the problem is you don't have the income levels that you had before the shutdown, before the recession began. And so the recession, this particular recession, people have this impression somehow that if we get a vaccine in sometime in the next couple of months, that's going to solve this. But the problem is that, as I've described, this had been such a long expansion of credit and of speculation in the economy and in the asset markets and in property markets in Canada in particular, as you know, Jim, that when you get the income legs kicked out from under it, the thing really can't stand up on its own. And I think that's why we're likely to see disappointing economic data. And, Gary Schilling is out with a piece just saying he thinks the recession is likely to go throughout 2021. So we're talking about I've been saying probably for the next year. Recessions, once they start, 9 months is a short one, a couple of years is sort of longish. Somewhere in that area is likely where we're going to land this time. And I think the more important thing is that people understand that it moves in waves, that it gets, very dark and pessimistic in the first leg, then there's a rebound of some optimism. It's typical for financial markets to rally, bounce back, buy the dip mentality, and people thinking, oh, it's fixed, and they pile back in, often with leverage, as I've said, just in time for the next leg down. Typically, these things are a process of space and time, of mean reversion of valuations and overpricing, of overbought conditions, which have been extraordinary this time. We are so far above, the NASDAQ was trading 30% above its 200-day moving average. Relative strength indicators, well over 90. I mean, these are technical terms, but for the average person, all you need to understand is that the euphoria and exuberance this time has been historic. And so whenever you get that kind of mispricing and overestimation, the economic story is likely to disappoint, that impression of perfection. We're in everything but perfect conditions here. And the smaller, even the Russell 2000 companies or the smaller, medium, publicly traded companies have actually been, negative in a bear market since about 2018. So again, this is about the breadth of who's been rallying, who's been getting access to capital, and it's that small bucket. But the bulk of the economy, the bulk of the jobs, are in the small to medium sector, which is struggling severely here. So I think it's going to continue to have a hard time over the next year, and that we should expect to see the next leg down where financial markets come to terms with the fact that they're so dramatically overpaying. The S&P price to earnings ratio right now It just on a trailing basis, looking back on the earnings that even in this extraordinarily high earnings period that we've had over the past few years for these large cap companies, it's trading at 27 times. The price is 27 times earnings. That's higher than it was in October 2007 and way above where it's considered to be sort of good value, somewhere in the 10 to 15 range. And we're in the top 0.4% of all historic times ever where you had things this overvalued. So I guess the more relevant question needs to be, I think if people look at, instead of looking at the manic, crazy stuff and deciding whether that makes any sense, I think they should really look at their own balance sheet, their own business, their own risk exposure and their savings and say, how can I be defensive and position myself to take advantage of what is likely to be one of the best buying opportunities of a generation? And I don't mean something that lasts 1 month like we saw in March, where things had a quick, drop down and then rallied sharply. A bear market is not typically that. A bear market is something that drags out over a period of many months and grinds prices down, and participants who are not prepared, really pummels them by the end when they actually give up and liquidate, typically at the bottom. And that is where an intelligent person today should be trying to figure out, how can I not be one of those people who does this wrong? How can I learn from this experience? How can I, if I remember the 2000 collapse and the 2007 collapse where I was taken wrong-footed, how can I be more sure-footed in this experience? And the answers are by reducing your leverage ahead of the crowd, by paying down your debt, by building up your liquidity, by not having your portfolio of savings all tied to the stock market or corporate debt, which has a massive mean reversion phase here where prices have to come down. And how can I preserve my liquidity and strength, both financially and psychologically, so that I am one of the very few who can prosper through these times and take advantage of liquidation selling. And if you can do that now, and yes, it takes personal discipline, and yes, you have to plug your ears and hum, so that if this rally, if there's buy the dippers come in here, if the Robin Hood crowd wants to go wild with derivatives for another couple of 3 weeks, whatever it is, that you are patiently confident that you have a solid foundation and that you're not going to be one of the victims. And all of that is very positive and exciting, but it really does take people to not lose their bearings.
We'll have more with Danielle Park right after this.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, are people with good paying jobs now being laid off?
So this is again about these phases, right? So the initial impact of shutting down the service economy primarily was this loss of service jobs, which tended to be in tourism and restaurants and what people consider the lower paying jobs. But what we've seen now is this move to cut costs, which is really a pandemic of its own. It is the revelation that many companies are finding that they're actually getting more productivity out of their workers by having them at home and or in decentralized work locations. And not only that, they're figuring out that they can do more with fewer people. So, once you've cut the worker bees, so to speak, the next thing you look at is the structure of all management and white-collar jobs that tend to be above them in the pyramid. And I think that is the next phase here where, not only are companies like Facebook, Apple, and Twitter and major financial companies, paying millions of dollars to get out of things like leases on expensive office spaces in main cities, but they're also looking at their management structure and saying, you know what, we don't need these 2,000 people or these 1,000 people. Or, I mean, every day you get major announcements out of large corporations where they're walking away from overhead costs in the form of people and also, premises. So this is a theme I think that will continue. And so this has wider implications for how do we, re-employ all these middle management people in this new system, which again, as I say, with revenue not bouncing back to where it was in 2019, possibly for a couple of years or more, you're going to have this ongoing urge. And companies are trying to preserve profit margins, right? This is their number one thing. How do they maintain liquidity and profit margins? So it's not something that's going away. And the longer the economy struggles, and the more automation and the more working remotely and all these things that companies figure out, the less they're going to need these other people. And of course, that's a challenge for an economy which in Canada is 58% driven by household consumption, and in America 70%. So that if you're laying off workers to make companies more efficient to try and preserve corporate margins, that's all fine and well, but it's not going to be great for revenue. And revenue is the lifeblood of the economy, right? Income stream, cash flow, money flowing through. So all of these things are going to be headwinds for some time.
Are we going to have to change the way EI is done in Canada, where you only have benefits for a certain number of weeks, then you're cut off, because obviously there are a lot of jobs that aren't going to be coming back?
Yeah, so this is going to be a very difficult tightrope to walk, because on the one hand, we want to encourage retraining, re-education, refocusing workers from, as I've said, some of the legacy industries that are in decline, some that are the rationalizing is going to continue to the downside. Coming out of, as we've been in this massive credit bubble, household credit has been expanding for 3 decades, right? So if we're in this mean reversion period now, which was inevitable at some point, you have to go through a period where you stop, as I say, they're cutting the lines of credit back now, even where people have access to credit. Households are starting to be more defensive, we've seen a big jump in Canada's savings rate for anyone that has capital that they don't actually need, or income that's coming in, they're saving a much higher portion of that. That's defensive behavior. Once you get that behavioral shift, it really continues typically for a good period of time. And so, how we compensate people while we're going through this big transition in the overall economy, automation, we've got reverse globalization going on in many ways in the protectionism that's building. So this urge to repatriate production to North America away from places like China, for many reasons is happening. That could potentially create more jobs at home, which could be a helpful factor in buoying the household income here. But it's one sort of factor in the face of many deflationary aspects, right? As in the spending less and saving more, the aging demographic, the downsizing baby boomers, the struggling millennials who are cash strapped, who are coming into the economy, the Gen Zs and Xers looking for work in the second recession now of the last decade, which is very, very difficult to get a footing when you're young trying to start out. So all these sort of factors are competing with each other as central banks are trying to create inflation. But if we look to Japan, we see that actually all these financial gimmicks have only managed to add more debt, and actually never attained their inflation targets, because we've got the weight of that debt as well as the demographics. And now we've got, very little immigration, which was the lifeblood of our increasing our workforce in North America has been immigration. Well, now we've got a lot less immigration coming in. So all these factors are ultimately, sort of having an arm wrestle to try and figure out if they're going to be able to create wage pressure, to increase the spending ability of households. And in the short to medium term, I think that the answer is we're more deflationary than inflationary, that we're going to have to look to different ways to compensate people. I mean, I understand people are worried about paying people to sit home, but there's a certain portion of the population that is never going to be working anyway, and we already pay a fortune for, whether it's welfare or disability programs, the EI programs. We've got a huge amount of bureaucracy that is there spending to try and keep those separate programs all afloat. Social services, all these different things. It's possible that we could have a lot more efficiency in the way that we administer baseline income to households if we look at new models. And I think that all I'm saying is we need to try these ideas because we're in a very unprecedented time for our generation where the old ways are not coming back soon. Probably some of that will never come back to the way it was. And this is an opportunity for a lot of growth and change. And that's all very positive, but we have to keep an open mind because if we keep thinking of the old ways of getting money into people's pockets, we may find that it isn't very effective here.
Danielle, thank you so much for chatting with us.
Hey, thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. Her website, jugglingdynamite.com. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.